You could please take your seats, make your way back to your seats, and we will be ready for action in just moments. So please do take your seats. Ladies and gentlemen, we are overdue. We need you in your seats. Please follow the example set by Regina Ip and other delegates that are leading the charge. Back to the chairs, as I'm about to go back on stage and bring on our next panel. The countdown is now. All right, ladies and gentlemen, we are back in action here at the summit hosted by the Hong Kong Monetary Authority. I'm going to ask all the good Canadians to take their seats. Hope you like the socks, Mr. Carney. You see that? You like that little Hudson Bay? Fantastic. And so you know that we are back, ladies and gentlemen. The doors are closed. The typhoon is outside. The brain power is inside this room. And we have a panel ready to go on side stage, ready for you. So this panel is going to be discussing sustainable finance. Now, whether it is environmental, social goals, or governance, ESG is very much in vogue these days. But our panel is going to be discussing how, and if it is possible, to make good on the promise of directing capital to virtue and profits. Fortunately, we have a spectacular moderator for this today. He was the former CEO Asia Pacific for JP Morgan before being elevated to their global head of private banking. Until all that happened, until early last year, he was appointed the Chief Executive Officer of the Hong Kong Exchanges and Clearings. Ladies and gentlemen, please welcome to moderate your panel, Mr. Nicholas Aguzin. Gucho, bienvenidos. We welcome to the panel Mr. Joseph Bay, the co-chief executive of KKR. We welcome Jin Lee Kun, who is the president and the chairman of the board of directors for the Asia Investment Infrastructure Bank. Thank you. We also welcome Anand Selva, who is the CEO of Private Banking and Wealth Management at Citigroup. And completing our panel, we welcome Hanneke Smits, who is the CEO for BNY Mellon Investment Management. Thank you very much. Gucho, the floor is yours. Take it away.
Thank you very much, and welcome everyone. Good morning. Great to see again so many faces in real person. It's a great event. Thank you, Eddie, for organizing, and all the HKMA team. We have a great panel with a diversity of backgrounds, people from the private sector, public sector, representing Asia, representing global, a lot of areas for a very important topic, and it's especially important for Hong Kong, being in the middle between China and the rest of the world, and in particular, a topic that is very dear to our heart at HKEX, because just last week we launched our climate exchange, which is a great initiative. We call it Core Climate, and it's going to be a great tool for making sure that we help in the transition. Now, today we're going to be talking about trends and how each of the different institutions here are tackling this sustainability challenge. And we're going to get right into it, and I'm going to start with Hanneke. Hanneke, I have a question for you around, is it possible to do good and to do well at the same time? And how should we be looking at the trade-off between social and private benefit? And let me add just one more point to this one. A lot of investors have been penalizing certain industries. In particular, oil and gas is one that's been discussed quite a bit. And there are many other industries, and we can think about agriculture and also electricity generation, whereby there are a lot of social benefits of really having those industries functioning, but they haven't been to the same level of scrutiny. So how are you looking at that, and how's your company looking at managing those balances?
Okay, thank you, Nicholas, and good morning. It's always a challenge to start with a two-part question of such great complexity. I also want to say thank you to the HKMA for hosting this. I actually started my career in Hong Kong in the late 80s and very much enjoy coming back and feeling its energy and connectivity to the mainland. I also thought it was very fitting, given the topic of this panel, that the last panel had a question on ESG and whether it's off the agenda. And I can assure you, as you can see on this panel, it is very much on the agenda and very much on the mind of investors, companies, governments, and the like. To the point, Nicholas, of whether you can do well by doing good, we very much believe you can. Responsible investment is really no longer a nice to have and is really increasingly embedded in all the investment decisions that we all face as investors and as shareholders. It's a very fast growing area of the market. I think you've all seen the numbers, and to some extent this is very much a shift in society from focusing on shareholder primacy to stakeholder responsibility. And ESG risks can really, speaking as an investor, can really no longer be overlooked when we value companies. They appropriately highlight the risks as well as opportunities and provide signals that drive valuation processes and can really materially impact intrinsic value. So I think it is actually absolutely possible to do well, to do financially well for investors by doing good at the same time, by focusing on companies that deliver sustainable business models. Now, to answer your question of how do we invest and where do we invest? Well, first of all, to address ESG, the world needs a lot of investment. We recently published a report that is showing that the world might need something along the lines of about $100 trillion to get to the goals of net zero by 2050. That's a lot of money, but in the context over a long period, we actually think it's achievable. Now, in order to do so, we must not shun the polluting sectors, and in particular, the sectors that need the investment the most are energy, utilities, and airlines. We believe it's very much going to be a combination of accounting for the value of stranded assets, which we estimate is going to be in the order of about $20 trillion. But we also, as an investor community, I think have a responsibility and duty to consider allocating capital to invest in those companies that need to align to net zero. So I think there's opportunities to invest. I think we must do it through engagement with companies and support them in their capital reallocations towards a greener world.
Thank you, Hanneke. And Joe, let me turn to you and to the private equity industry. And the PE industry obviously has been laser focused on returns, and KKR has been doing a lot in terms of sustainability. Particularly, you've launched a dedicated impact investing fund. And then in addition to that, you've been very focused in promoting transparent reporting practices such as TCFD, aligned climate disclosures. So would love to understand a little more what's driving your decisions, how you're thinking about this, and the role that you play in the sustainability agenda.
Great. Well, thank you, Gucho. Let me first start by saying thank you to Eddie, your colleagues at HKMA, for having us here today. As also a former Hong Konger, I lived here for 10 years. It is really terrific to be back, to see the energy come back to the city, to see our colleagues, our friends, family, et cetera. So thank you for having us today. You know, this topic around sustainability and responsible investing, I don't think is at odds in any way with making great returns. I actually think it's foundational going forward to making great returns. Our job as private investors and also on the public side is to invest in companies and make them stronger, to build better businesses, more resilient businesses, to minimize the risk while you're owning these companies, and create something that's ultimately more valuable 5 years, 10 years down the road when you either take the company public or sell the business. And you can't do that in today's world unless you have a real focus and competency around ESG, around sustainability, and a focus on being really responsible owners of assets in the world. So for us, this journey is not a new phenomenon. We've been working on this for the past 15 years, really, in terms of trying to institutionalize these capabilities and practices. We partnered with the Environmental Defense Fund back in 2008, actually, to create a green portfolio program for KKR portfolio companies. We started publishing an annual sustainability report back in 2008, which we publish every year. In 2011, we started focusing on more the S of the ESG, which is broad-based ownership in the companies that we invest in, where we push stock ownership down to every single employee in these companies. That employee engagement is critical in a world like today where labor is in short supply, where people are worried about retention. That's proven to be an incredibly powerful tool to improve productivity, to align the workforce with management, and ultimately with shareholders to create more value. And what's exciting about today's world is when you have a focus on sustainability, there are incredible opportunities to invest today. This brown to green transition, which was just referenced, is going to create tremendous value. The opportunities for our impact fund, which are aligned with the United Nations SDG targets, our infrastructure business globally, that's investing in renewables. It's just an incredible time, actually, to have this focus for both great financial returns and to do the right thing.
Thank you, Joe. That's great. Anand, next question is for you, and tackling the E and the S in ESG. How do you think these two work together in terms of advancing the global sustainability goals, and what's your firm doing in terms of promoting sustainability?
Good morning, everybody, and thanks to HKMA for having us here. It's wonderful to be back in Hong Kong after 2-3 years, so good to be here. So the E&S absolutely go hand in hand, and our financing commitments at Citi are aligned with that approach. We look at it together. So we have a $1 trillion goal for, towards a $1 trillion goal in 2020 and 2021. We have financed and facilitated around $220 billion. It's a spectrum of activities. So if you look at the environmental activities will include clean technology, renewable energy, water conservation, sustainable transportation. And if you look at the social activities, it's around education, it's around healthcare, it's around affordable housing, food security. So it's been a wide spectrum of activities. And when I look at it in Asia here, Asia is a great example. We've had several firsts in Asia around green bonds, as well as in sustainability offerings with companies like LG Chem, BPI, Woolworths, to name a few. We also, last year, for our Asia clients, we raised over $40 billion in global and local capital markets to support their sustainability financing needs. So we've been working with our clients and helping them out. And in Hong Kong itself, we have one of the examples here will be our building, City Tower building. It is the largest on-site renewable energy system that we have. So we have been working with clients to helping their needs and helping them transition to net zero. At the same time, we've also been driving actions ourselves for the better of the environment and for long-term benefit of the communities. So a lot of activities, and it's a spectrum of activities, Nicholas.
Thank you very much, Anand. Jin, going back to AIIB, as a multilateral development bank, you play a key role in trying to bridge the gap between return expectations and also bearing some of the risks to help in this objective. So what are the tools that AIIB has to be able to deploy for this purpose? Have they been effective? And then also, I know you have a big war chest to do this, but the task ahead is really big, and there's a lot of capital needed in this transition. So what other parties can you enroll or enlist to try to help in this sustainability fund?
Thank you very much. It's very nice to be back in Hong Kong after an absence in international forums for a good 3 years. And it's so nice to see you in person. And I would like to say just a few words about Asian Infrastructure Investment Bank as a multilateral development bank. Probably people don't know very much about what it is all about. You know about the World Bank, ADB, EBRD. Our bank was created in the 21st century with the developing countries as majority shareholders. So this is a little bit different, even though we are patterned on the Bretton Woods institutions. But this is the first multilateral development bank with developing member countries as the majority, with our shareholders from all the continents except Antarctic. Now, this is a very important feature. You may ask me, if the developing countries are the majority shareholders, what is the incentive for European countries, developed countries to join? Because you made the rules, you play all the rules. Is there any rule for us to play? The answer is yes. We have very good check and balance. And European countries and also Canada, they have more than 25% of the votes. The major policies approved, or the election of the president, must have 2/3 of the members and more than 3/4 of the voting power. Which means even though China is the major shareholder, China will not simply call the shots. So this is the very good teamwork spirit. And just because of this nature, the bank focuses very much on development by very high standards. And we talk about ESG, we talk about green financing, sustainable development. And all this is deeply embedded, all these principles deeply embedded in our Articles of Agreement. So you talked about a war chest. Actually, it's quite negligible compared to the major financial institutions represented here. We work with BlackRock, JP Morgan, Morgan Stanley, HSBC, and all these institutions. I think our resources are very much limited. So what we do is try to leverage our resources to mobilize the private sector money for sustainable development. I think what is different today, we should never ever count on the public money for development. And I don't think it's right for development banks to knock on the door of the major shareholders asking for general capital increase every couple of years. That's not sustainable. So we focus very much on the cost effectiveness, and we look at the very essence of how to develop the infrastructure projects. We call it infrastructure for tomorrow. What does that mean? It's not infrastructure projects which are designed and implemented in a very traditional way. We incorporate climate change mitigation adaptation, and we have the framework to monitor the effects. For instance, all of the MDBs work out a climate change mitigation adaptation tracking methodology. So you look at our performance by all these public standards. Let me stop here.
Yeah. Thank you. Anand, I'd just like to follow up on something you mentioned, which is the $1 trillion commitment that Citi made in terms of sustainable financing by 2030, I believe, correct? And I mean, clearly you have a very international operation. And I mean, how do you square trying to maintain consistency and a uniform standard with the practicality of having local operations and very local characteristic in each of the markets where you operate? Do you try to apply a consistent standard across the world, or do you take into account differences in each of the local markets where you operate?
Thank you, Nicholas. Great question. Similar to how we run our global businesses, we don't take a one-size-fits-all approach. We play to our strength, our global network, our global capabilities, and also our local expertise. So we have on-the-ground presence, so our on-the-ground presence, our relationships on the ground, our local capabilities are very important because that positions us uniquely to help our clients' individual needs. At the same time, we are very mindful that countries are at different stages of development, right? And social and energy needs vary by country. And sustainable development efforts are inherently local. I mean, issues like energy and food systems are pretty much hyper-local. So we lean into our local expertise to understand the local markets, the demographics, the local social and environmental challenges, and then combine with our global capabilities. So while towards our $1 trillion goal, we have global policies, global programs, but we marry them with our local on-the-ground presence. Now, as we build all of this, as we continue to all of us work together to reduce emissions, I think there are a few things we need to do. One is we need to find mechanisms where, from a funding perspective, as we fund decarbonization, the funding needs to be efficient and equitable. Today, most of the funding goes to investment-grade markets. The emerging markets are not getting the funding. And you cannot expect the emerging markets to be spending on decarbonization at the cost of their economic growth because they have their own set of social challenges that they need to deal with. So it's our responsibility to help scale the funding, getting the funding for the developing economies, as well as looking at opportunities to fund new industries that support sustainable development. Now, all of this is doable. As we do all of this, I think one of the things that we need to work on is data. So we know that availability and the quality of ESG data has been an industry issue. Regulations are localized. You have disclosure requirements that vary. That leads to fragmentation of data, which leads to data complexity. So that's something we all have to collectively sort of solve for. And I guess there's an opportunity in Hong Kong for Hong Kong to take the lead, and being the leader in ESG in the region, and continue to lead in developing international standards, establishing regional sort of best practices and disclosures. Then you can sort of, we have to overcome the data complexities that we have and the fragmentation, and there's a great opportunity for Hong Kong to do that, and also build out a carbon market here. So that's how we approach Nicholas. So it is not a one-size-fits-all. You got a bit global and local altogether.
Okay, thank you. Jin, you're headquartered in Beijing. You invest across all of Asia. And by the nature of your institution and the projects that you invest, I mean, you're subject to a lot of scrutiny. In a world where, especially around sustainability, where we don't have standardization and there's increasing risks of like greenwashing, how do you manage those risks and that lack of standardization? And in particular, last year, you launched the Sustainable Development Bond Framework. So can you tell us a little bit more about that as well?
Well, thank you very much. The challenge of a multilateral development bank, particularly with China as the biggest shareholder, is formidable. And I know quite a lot of people put this bank under the microscope. If there's any defect, they are going to magnify it exponentially. So we are very careful. And reputation is very important. From the day one, we made it very much clear that this bank would go by international best practice. We would have very solid environmental social framework to follow. But we know reputation is something, or trust is something you have to earn. You cannot talk people into believing you. 7 years into operation, we grew from 57 founding members to 105. Why do these countries join us along the way? Because they believe we do what we declare. Okay, we mean what we say. So when it comes to the operations, for instance, everybody now is focused very much on climate change. As I said just now, climate change, mitigation, adaptation is very much important. And you cannot tell the people, we are doing wonderful things. By what kind of standards? That's why World Bank, ADB, this bank, they all work together to produce the climate change, mitigation, adaptation tracking methodology. Likewise, ESG, environmental social framework, we have to process each and every project to make sure they will not violate international standards with regard to, for instance, environment. We are to improve environment, not to destroy environment. So everybody is watching us, and powerful CSOs, NGOs are following very closely everything we do. Now, talking about greenwashing, how can we make sure it's not greenwashing? For instance, we have this framework. Sustainable development framework would give you clear indicators. And we issue bonds, for instance. We can issue green bonds. And the green bonds would be earmarked for instance, climate change mitigation projects. But our framework covers more. We work with the financial investors, institutional investors, making sure that this is a holistic approach to deal with the climate issues. So I think it's better than simply issue green bonds, which means everything we do, all the financial resources raised from the market would be for climate change mitigation. So I think there are lots of things I have no time to elaborate, but by actual work on the ground, we can enhance people's confidence in this institution. I know it's very easy to lose confidence. When you lose confidence, they will never come back. Thank you very much.
Thank you. Hanneke, some people in the sustainable investment community point out that Asia is actually behind the other regions in terms of promoting sustainable investment practices. So can you tell us a little bit about your observation in terms of where client appetite, readiness between clients in Asia and the rest of the world is?
So sitting here in Asia, I would say the region is catching up relatively fast. It is behind certainly Europe for sure, and to some extent the US, but we're seeing both from an investment required perspective as well as what we're seeing from our clients. We're seeing an increased desire and need for sustainable investment objectives to be integrated in the portfolios. And we also have started to see a framework being developed by the various regulators around the region. As previous speakers on this panel and the other panel have mentioned, clarity around data disclosures is really, really important in this context. So I think also this is to some extent, this catching up is also happening because this region is feeling very keenly the effect of climate change. I mean, we're sitting here, thank goodness the typhoon is sort of reduced, but the floods everywhere, increase in typhoons is bringing many of these issues to the fore, including of our investors and our clients. And having said that, sitting in emerging markets and in this part of the region, it actually needs about half of the investment that I mentioned earlier of this 100 trillion that is needed to get the world to net zero by 2050. And that is because the economies here are projected to grow faster, they're energy dependent, and so therefore it needs even more capital than we see in the developed markets needs to actually get to that greener future. I also think there's a great opportunity here from an investment perspective to leapfrog some of the carbon-intensive technology that we see is very much embedded in developed markets. And an analogy that comes to mind was how mobile phones leapfrogged the needs in Africa to actually lay down landlines which weren't in existence and saw an explosion in growth. And I think in the same way here, there's an opportunity to make some very interesting investments that are less carbon intensive and providing good opportunities in a sustainable chain. But with that, we must make sure we get better data and better disclosures, because in the short term, what we're seeing is there's a little bit of the knee-jerk reaction and risk that investors in the region divest rather than invest in the sectors that actually need it most.
Okay, thank you. Joe, you mentioned you lived for many years in Hong Kong. You know Asia very well. So how do you see the Asian landscape, and what are the challenges and opportunities in terms of sustainable investing? And you agree with Hanneke that Asia is catching up very quickly?
Yes, I definitely agree with that sentiment. You know, I think the context matters again. When you think about climate and carbon, the three biggest carbon emitters in the world are China, the United States, and India. For the world to really make progress around carbon and decarbonization, you need Asia to be a leading force in that, given the presence of China and India. The growing energy consumption, given the demographics, given the young populations, this is going to be both an enormous challenge for Asia, but also a tremendous opportunity for investment. And I think I'm more optimistic that regulators, governments, private sector will find a way to harmonize the data piece of this over time. The measurement of every company and reporting. I think that's something that will get done in a reasonably short period of time. I think the really hard work, though, is how do you actually not only measure, but what are the strategies to actually materially decarbonize and improve? That work is really, really difficult. As shareholders, as owners of businesses, I think that's where the focus needs to shift, is less about just getting the reporting right, which is foundational. We need to do that. But then it has to shift to what does it mean to be a responsible owner of a business? What are the right targets to be setting for management? And that's an infinitely harder, a problem to crack.
Okay, thank you very much. And I'll have now A last question for all the panelists. Hanneke, maybe I'll start with you. I mean, around the approach that we're taking to climate change today, do we all believe that this is adequate, not just quantitatively also, but from a quality point of view? And should we look for other ways to tackle the problem?
So thinking a little bit through sort of the theme of this, of today, you know, how we navigate uncertainty, I just want to first say the one thing is certain is that we must address the challenges that are upon us with respect to climate change. And combating climate change is clearly an enormous task, but it is still something that we believe is not insurmountable if we ensure that finance is being directed to the areas which most urgently need it. Now, the investor community cannot do it on its own, right? We're going to have to collaborate with government and policymakers to ensure that the right incentives and frameworks are put in place so that we can together achieve the goals that are needed by 2050.
Okay, thank you. And Anand?
Yeah, I mean, clearly sustainable finance is the future. There are obviously the things that we talked about is the interim that we need to work through. And financial institutions have a role to play in helping clients to transition to net zero. There are 2-3 things for me as comes up. One is obviously data. We talked a lot about data, so that's something that we all need to work on. And I think one of the things that I've found very encouraging listening to my Hong Kong colleagues here is that in Hong Kong, HKMA's Green and Sustainable Finance Center is working on developing talent and data. I think that is good. We need more of that. That is one. Secondly, obviously, I'm saying the obvious, we need enabling public policy and regulations. Because what we need is clarity and consistency, like we talked about in disclosures and in terms of data. So I think that's an important imperative there. The third is, Hanneke was saying, it's about partnerships. No single country or a single company is going to make this work. So it is all the stakeholders. It's a big teamwork of, it's the policymakers, the regulators, it's the FIs, it's the development banks, it's the civil societies, all need to come together to sort of drive this. At Citi, we are taking a long-term view on this. This is a 30-year event, right? And it's going to have significant upfront financing cost as we are sort of transitioning to clean energy and et cetera. So that's the way we look at it. I just thought a little bit of shifting a gear a little bit for a second. You know, I manage the wealth business. So when I speak to my wealth clients, it's very interesting. The wealth clients are more and more now focused on ESG as they're investing for themselves. And that has never happened before. So we see that happening. And we have a platform called Investing for with Purpose. And our clients, we help our clients use that platform to make responsible investment decisions. And when this whole intergenerational wealth transfer is happening, which is estimated to be about $15 trillion by 2030, the next generation that's getting the wealth transfer is even more ESG conscious. So there is hope here. I mean, people, it's not only the institutions, even the individuals, as they're investing, they're looking at ESG and they're very focused on it.
Yeah. Jin.
My view is that sustainable financing ultimately depends on the quality of the investment you make. I would say gone are the days when the private sector could come to certain investment, make quick wins, and leave. I think time have changed. And even private sector investors will have to comply with quite a number of very tough standards. So how could we make sure that what we invest today would give us a long-term benefit, not individually, but collectively? I would say, for instance, we invest in infrastructure, which has a long gestation period associated with risks, particularly with regulatory and macroeconomic risks. Your due diligence of a project could be very good, but you didn't know about the macroeconomic or geopolitical storms. So individually, I think it will be even more difficult for the private investors to be assured of their success. That's why we need to work together. And also, I hope the investors who work with us will not expect this bank would close the gap of risk-adjusted returns. I don't think we can do that. But there's one big advantage of working with the multilateral institutions like our bank, IFC, or EBRD, because we have maintained a dialogue with the host country governments. Even though the projects we finance are private, we don't have guarantee, but we want to make sure that macroeconomic and regulatory policies are in good place. If there's any change, they should be changed for the better. So I think we work together to create a very good environment for sustainable investment. The projects you finance are sustainable, and your financing will be sustainable. Thank you.
Thank you, Jin. Joe, your thoughts?
Well, listen, I do think there's a lot of progress being made. I think it's important to recognize, though, that whether it's companies, there are no two companies that are the same. They have different issues, different challenges, and one size does not fit all when we're talking about climate or ESG. And the same goes with the access to capital in markets like Asia, right? We have obviously as China and India as two enormous economies where capital access is very different than, say, Southeast Asia. Smaller economies, less developed capital markets. So I do think there needs to be this recognition that where private capital certainly could add value is in some of those gaps. One of our largest investments through our infrastructure fund is in the Philippines, in First Gen. They produce almost 20% of all the electricity in the Philippines, and it's almost all renewable. It's geothermal, hydro, wind, and solar. But the Philippines is not a market that gets a lot of capital flows from international capital. Certainly from development banks and local banks, they'll get some capital, but there are real gaps in terms of just availability of funding. And I think that has to be a big part of the solution in this region.
Well, thank you very much to all my speakers. We're getting to the end of the time. We may have time for one question from the audience. So any questions for our panelists? Yes.
Thank you very much, Nicholas, and thank you very much to all members of the council, of the panel. My name is Tony Neo, and I sit on the board of ICBC and CITIC. And we completely agree with you that ESG is an organic part of the business environment, and it is there to create value for our shareholders. But I'd like to just drill down a little bit on the specifics. We have been seeing, in fact, in the past maybe 10 years, an increase in public and private participation, which is known as PPP, for the investment of infrastructure and so on. We see securitized projects, a securitized product coming out of these. The UN is very much involved in setting standards for PPP. I'm involved in one of those working parties, and I'd be very interested to know your views on how PPP could be effective in financing development, how in your portfolios you see PPP as being an effective method for creating value. Thank you.
Thank you. As a result of time limitations, maybe, Jin, you can take that one.
Tony, thank you very much. Nice to see you. It's a long time. I think this is a very important topic. So far, I would say PPP projects outcome seems to be mixed. And you cannot put down to any single root course if there's any problems with the PPP projects. The course for the public sector and the private sector work together. But there are also some very good projects in terms of PPP. I think, first of all, the government should provide facilities, but the government should not behave like a mother-in-law. You know, this is very much important. And the private sector should also know how to behave. I'll give you one example. Some very successful PPP projects in China. It's healthcare, old age care. The government provide low-cost land. And the private sector build the healthcare or old age nursing homes and this kind of thing. And they work it out very well, because taking care of the older people it's a challenge for China. I think it will be increasingly difficult, but you cannot depend on the public money to take care of so many Chinese old people over 60 or 70. I'm young. I'm 36 years old, only the second round. So I don't need this kind of thing, help so far. But I do know there are lots of people who need it. So the projects I referred to, government provide low-cost land or some other facilities, private sector put money, and they work together on the market basis. I think that's the best approach. Thank you very much.
And thank you very much to all my panelists and to everyone. The conclusions of this is that this is an evolving space, a lot more to do, and we look forward to continuing the dialogue. Thank you very much.
Muchas gracias, Senor Aguzan. Thank you. If we could prevail upon our panelists to head to the center of the stage for a photo, that would be wonderful. Thank you. Thank you once again to our panel. I would like to remind everybody that there's a lot happening in Hong Kong this week. This is also Hong Kong FinTech Week is happening right now, and there's a bevy of events happening in the lead up to the triumphant return of the Hong Kong Rugby Sevens. So I hope that you're going to be sticking around for the rest of the week and beyond to enjoy Hong Kong. Now, our next panel is going to be looking much farther than 1 week into the future. Whether it is artificial intelligence, crypto, DeFi, big data, my thing, central bank digital currencies, there are a host of new technologies on the horizon that are impacting now, and they are changing how we think about finance, how we think about banking, even how we think about the fundamental nature of money and society's relationship to money. Fortunately, we have a fantastic leader for this panel to look at technology, innovation, and the future of finance. He is Neil Shen, the founding and managing partner of Sequoia China. He has topped Forbes' Midas list on multiple occasions and is now ready to lead our panel today. Neil Shen, please. Joining him on today's panel is Rob Capito, the president of BlackRock. Also taking the stage is Daniel Pinto. Daniel Pinto is the president and chief operating officer of JP Morgan Chase. We welcome today Noel Quinn, the group chief executive for HSBC. And appropriate sitting next to him, as their buildings do in Hong Kong, the group chief executive for Standard Chartered is Bill Winters. And with that, Mr. Shen, take us to the future.
Thank you. Well, first of all, I'd like to thank Eddie and his team for hosting this wonderful event. And I'm so honored to be here and moderate this panel, which will talk about the technology, innovation, and the future of finance. So I think technology is really reshaping the future of finance, and probably no other innovation have come to epitomize the potential of the tech in finance as blockchain technology. While we have seen some interesting transactions, most of those are still very small, and DeFi uses are still not mainstream. The bright spot is that 2 days ago, the Financial Service and Treasury the Treasury Bureau in Hong Kong has issued a policy statement on development of the virtual asset in Hong Kong. And thanks to Paul and his team, and I think this is clearly very, very enthusiastically accepted by the market. I think we have 3 pilot projects. One of them actually relate to us. There is an NFT issuance for FinTech Week. I don't know if any of you has download that and get that. I was told that you need to go to the physical counter to get that. But it's a very interesting trial, I think. And then we're talking about the tokenization of the green bond, and obviously, very importantly, the e-Hong Kong dollar. So the first topic I think we should ask in this panel is about blockchain. And the first question goes to Daniel. I mean, JP Morgan has been trying the blockchain application with payment. Can you share some thoughts on that, and what could be done, and what further could be done with that technology?
Thank you. Thank you, Eddie, for the invitation. It's great to be here after 3 years. So we started this journey a long, long time ago. So when Bitcoin and other cryptocurrencies started being a bit more popular, inside the company, you have all kinds of views. People that were positive, people that were negative, but we were all fully aligned was about the power of the technology underneath. And also we realized that in the form that it was used, it wasn't exactly the type of technology that we need to be helpful for our clients and for us to process a lot of transactions per second and all that. So we developed first a platform called Quorum, which is our distributed ledger platform. We made it open to everyone, an open source. Every company could use it. And that was the base. And from there, we started thinking and developing products or services that would be run on that platform. The first one was Links, which is essentially a network of banks. So 400 of them, they are signed up. Close to 100, they're already operational there. And essentially, it's a way to exchange data for validation of payments. That is something that exists in the US. Still, people write a lot of checks, and they go in boxes around the country. We have created a product to digitalize and stop that. And in the future, as more and more banks come into the platform, we will see services related to fraud, services related to foreign exchange services, so other things. It's an open platform. The banks that they are in the network could, any of those, develop products and distribute them to that platform. And then from there, you start thinking about what else was possible to do. So we created JP Morgan Coin, which is essentially used for several companies around the world to optimize their flow of payments with their accounts around the world. So liquidity, and it is expensive, it's going to become even more expensive, so it makes a 24/7 platform to optimize that. We work with the Monetary Authority of Singapore, DBS, Standard Chartered, Temasek, to create a network of payments 24/7 to process payments in dollars and in Sing dollars that we're about to launch, and over time it will be more and more payments. And as time goes by, digitalization of securities, tokenization of deposits, that is coming. And as it's coming, you realize they're going to face the challenge of having to operate in a public blockchain instead of in a private one. So therefore, we are working on tokenizing identity to be able to be in that open environment in a secure way. So we are at the very, very beginning of the journey here, but what it feels to me, even though it's been very slow over a period of time, I think that this is the time where this type of technology, these type of use cases, they are going to really accelerate substantially.
Thank you. Now to Rob. So you have Aladdin, and Aladdin has worked with Coinbase, which is a very major crypto exchange for collaborations. And at the same time, you have invested in the stablecoin exchange called Circle. So share some thoughts, behind those investment and those, partnerships.
So let me pick up where Daniel left off. So I think in talking about this, we have to be very careful about the terms that we use. Blockchain, crypto, cryptocurrency, all of these things have very, very long stories and are very complicated, but it's all in the same thing to digitize the financial ecosystem. And so everybody in this room is going to be part of this in one way or another. And I think that my colleagues represented here are already pretty far down the path in something that's pretty new. We have a risk system, which I see some people in this room that actually participate in it, called Aladdin. And we have noticed over the past couple of years that the growth of digital assets and the blockchain, what we'll call ecosystem, is really starting to pick up pace. And what happens is I start to see an increase from our clients in wanting to invest, as well as internally from my technology department to want to understand the applications for our entire industry. So I do believe that digital assets and blockchain technologies are going to become very relevant for asset managers like BlackRock and our clients. It's going to involve how we choose to manage portfolios. More importantly, how we interact with my colleagues on the stage, and of course, how we operate in the new markets ecosystem. So what have we done? I look around here. I have spent a lot of time with everyone here trying to understand where they are and what their research is, from the exchanges to the banks to the other asset managers. The one thing I can tell you is everyone's spending a lot of money on trying to figure this out. So we have taken a series of steps. It's driven by client demand, the technology, as I mentioned, and I believe the maturation of the crypto asset ecosystem. There's a new word that we can use. So what did we do? We created a partnership with a company called Coinbase. You're probably an original investor in that, if I know you.
Unfortunately, I don't.
I'm sure. To provide common clients of Aladdin and Coinbase access to digital asset trading life cycles within the Aladdin workflows. So today, Aladdin clients who hold crypto exposures are only able to go through processes that take place outside of the integrated Aladdin platform. And so this integration that we're going to do supports Aladdin's core mission, which is to provide solutions that support a great portfolio. So by connecting Coinbase's comprehensive trading, custody, prime brokerage, and reporting, we're going to take those capabilities and put them into Aladdin workflows so common clients can manage their crypto exposures alongside of what you mentioned, Daniel, the public and private investments, enabling what we will call an efficient operating model and risk controls. So this is looking at the technological part of what we call crypto through a company called Coinbase, which has really built some incredible rails that are different and more efficient than the current rails that we currently use. And then the second thing is I created a minority investment in a company called Circle, and they are the issuer of USDC. That is a dollar-based, fully reserved stablecoin. And with that investment, there's currently 45 billion of USDC in circulation already, of which, through my partnership, we're the primary manager of the assets backing USDC. So I think that stable coins have a real potential to drive efficiencies and disruption across payments and capital markets activities. So we're working with Circle now to explore those opportunities where we may be able to enhance financial inclusion in the payments domain, enable frictionless real-time settlement with the capital markets, which is really quite astonishing that we can move money in a second without posting collateral, which will change, again, the ecosystem and the efficiency and the cost to our clients, and also increase the efficiency with my colleagues here of how we interact going forward. So there'll be more to come on this.
Thank you, Rob. So we talk about Coinbase. Indeed, this is one of very, very few crypto exchanges which has largely complied with regulators globally. Now, regulators has looking at this technology and asset very closely. And one thing other than stablecoin they have been developing is obviously CBDC. This is obviously creating a lot of impact to the banking industry. So my question is to Noah and to Bill, so what does CBDC mean for you? Is this good or bad? I mean, I think the Hong Kong dollar is very much a CBDC. So we'd love to hear your comments.
It's good. And let me give you a bit of context. Last year, HSBC moved around $660 trillion of money around the world. 98% of that was straight-through process, digital execution. Now, so digitization of banking is happening and has been happening for many years. In fact, if I go back through the archives of HSBC, the first digital banking platform for treasurers was probably launched about 30 years ago, called Hexagon. It then morphed into version 2 called HSBC Net, and is now on version 3 on our technology base. So digitization has been happening for a long time. If I look at CBDC, digitization of real-time payments in domestic sort of retail banking has happened around the world over the past 5 years. And therefore, there's a questionable case for CBDC because real-time execution and transfer of liquidity from one customer to another in a domestic market is good. It's happening. However, real-time payments for consumers and businesses cross-border is not yet happening. It can happen within a banking network. So each of us here can move money to our clients real-time overseas if they're in the network of the bank. But going outside of that network, I think there's a big role for CBDC and blockchain to actually effect real-time movements of money cross-border, low cost, immediate transfer of funds. And I see blockchain as a great piece of technology to satisfy that requirement, and that's why I know Bill and ourselves are working with Eddie here to bring CBDC out of the concept into the reality. Pilots already run, and I think that can be a big impact for small and medium-sized businesses to get the benefits of real-time movement of money cross-border that the large corporates get today. And I think that can unlock and facilitate international trade. And credit to the HKMA for putting that collection of countries together to bring this to market as a real solution rather than just a concept. Now, blockchain more generally, we did our first trade execution on blockchain probably about 4 years ago. Blockchain as a technology base.
Which sector? Can you share some a little bit detail?
We did the first trade here. I think it was a trade between Asia and the Middle East, a real-time trade, not a pilot trade, executed on blockchain. So blockchain as a technology has a place, but it's not the only technology to solve some of our digitization solutions or problems.
Thank you. Bill?
I think each of Noel, Daniel, Rob covered a lot of ground. I think one of the interesting questions is why the world needs CBDCs as well as the stable coins that Rob was talking about. Circle was the example, of course, there are others. And they're gaining tremendous traction. The CBDCs, some would argue, are a response to private sector stablecoins. The fear that monetary policy was going to be wrenched away from central banks and that the money flows would be less visible to central banks than would otherwise be the case. And that in and of itself is a motivation for for CBDCs to exist. But it's probably not a good motivation for a CBDC to thrive, because at the end of the day, if you talk to Rob's colleagues at Circle, they spend their days and nights thinking about how to embed themselves in the digital economy and how to make the customer experience a better customer experience. And as much as I love central bankers, they don't wake up and go to bed at night thinking about the customer experience. They wake up and go to bed at night thinking about financial stability and monetary policy and economic growth, things that are critically important. So the key for me is I think these things can coexist. We know that through regulation, CBDCs can not just displace stable coins, they can displace banks. I don't think Eddie wants to be in the credit intermediation business in a major way, and I haven't heard that from any other central bank either. So there's always going to be some, well, I hope there will be some guardrails on the amount of CBDC that is in issuance, because those are deposits that will not be in banks. Right? That's the nature of a CBDC. So I think that there's some really fascinating and thorny questions. How do you get to the customer use case most effectively? What's the role that a central bank should play in that? And how does that interact with the primary functions of a central bank around financial and monetary stability? There's a solution to, there's a nexus around those various questions. And I think central bankers are approaching it very, very, very thoughtfully. I think there are other use cases. There are surveillance use cases. There are financial crime use cases, or fighting financial crime use cases, which run counter to some other objectives that we've got around free flow of information in markets and transparency. I think these are extremely vexing questions that will be tackled by some central banks, not all. We're at a super early stage in this process, but I think at the end of the day, if we get a better customer experience and less friction costs, very much to Noel's point, this can be a successful venture and can coexist private and public sector.
Thank you, Bill. And then we're going to turn to the role of digital technology in banking. So back 3 years ago, the Hong Kong Monetary Authority gave out 8 virtual banking licenses. One of them is Mox, which is a subsidiary of Standard Chartered. So I'm going to lead the question with you again, Bill, that how this experience so far, how is Mox doing? And you also have your own online banking. So are you worried about cannibalizations between your subsidiary like this versus your own operations?
So first of all, I'll say we are extremely grateful to the HKMA for having given us a digital banking license. That was a big experiment in the beginning. I think it's an experiment that's worked well for the population in Hong Kong. Mox, and we built our first de novo digital bank called Mox in Hong Kong. We've now replicated that in Singapore with a bank called Trust. You're correct that we control Mox in that we own 65% of it, but we have Mox is a partnership between Standard Chartered, Hong Kong Telecom, and Trip.com, the Hong Kong Telecom Group, which includes FWD and others. So it's been extremely successful so far. It's certainly relative to our expectations, 400,000 customers. We've got a full range of deposit, savings, credit card, soon to be credit, and wealth products. It's got the top app store ratings of a financial services app in the world, and has maintained that position for 2 years, and it's gaining tremendous momentum. We expect that it will break even sometime towards the end of next year or early 2024, which for a digital bank, standalone, is pretty good. Why is that possible? Well, it's not because our deposits are different than Noel's deposits, or for that matter, the deposits sitting in Standard Chartered Bank. A deposit's a deposit, a loan's a loan, a credit card's a credit card. Yeah, we can play around with reward points and all that, and we do. The difference has to be the customer experience, again, but 2, the nature of the partnership. So in Hong Kong, the partnership with Hong Kong Tel and Trip, largest online travel agent in the world, obviously not the best time to partner with an online travel agent, but it will be, right? And we're all evidence of that.
Thank you for that comment. Actually, I'm a co-founder of C-Trip.
I know that.
I think I'm very glad that I'm oftentimes when I opened the Trip.com Hong Kong, I saw the Mox popping up. So.
And you have a Mox account, Neil?
Have not. You need to convert me into.
I'll see you afterwards.
Okay.
But no, in Trust Bank in Singapore, which has also added 400,000 customers, but in that case, in just a couple of months, far exceeding our expectations, with an equal balance of credit and current account subscriptions. Our partner is the FairPrice Group, which is the ubiquitous grocery store chain in Singapore. Every Singaporean touches the FairPrice Group every day once or twice. And so what's different about the virtual banks is the nature of the coalitions and partnerships that you can create rather than the nature of the banking product itself. Although, of course, if the banking product is no good, nobody's going to use it. So yeah, it's been a huge success for us. We'll continue. We've got 9 digital banks in Africa. We've taken a different route in markets like Korea, where we helped build Toss Bank, and in Taiwan, where we helped build Line Bank. We're a minority shareholder there, not controlling, but very, very successful banks with a couple of million customers apiece. Et cetera, et cetera. So I do think that it's an alternative to conventional banking. You asked, is it a problem that we're cannibalizing our own business?
Yeah. Are the two products really the same, or there are very different customer base, or
We've targeted the Mux product at younger customers, although interestingly, it's been taken up as much by people my age as it has been by people in their 30s. It's a little bit more mass market product, and Standard Chartered is a bit more of an affluent-oriented bank. But yeah, of course, we're cannibalizing ourselves, and I can tell you it's made Standard Chartered Bank better by virtue of that.
Thank you. So you are very happy with the partnerships, and you are replicate that to other, Yeah. Great. So the next question will be, given to both Noah and to Daniel. So when you look at the whole digital banking, there are some new entrants, and one of those are the so-called big tech companies, whether it's the Alibaba or the Google of the world, or whether some startup companies, for example, New Bank from Latin America. So those are called the challenge banks. Are you worried about those competitors, which has really so-called mobile-centric and mobile-native startups, and they have some wonderful technology and claim that they can change the whole banking industry? So what's your take on these competitors?
So when I look at the retail business, so the model that really has worked the best so far is the hybrid model, where you have optimized branch network and provide amazing digital services to your customers, and you use both. And that is a model that we follow in the United States, extremely successful. 65 million customers, 18% market share in credit cards, 11% of the national deposits, million small business that we cover. There is no doubt that the big platforms will go into that space and compete. Also no doubt that to replicate that model somewhere else is impossible, because it will take billions and billions of dollars over such a long period of time that it will really make the journey almost impossible for any bank, regardless of the size. So then we thought, so how we are going to diversify our business by growing outside the United States? And the answer was digital. And we chosen the United Kingdom, a market that we know, and we launched Chase in the UK, a pure digital bank. We were expecting to find 500 customers in the first year. We have over 1 million, 12 billion pounds of deposits, and it's growing very, very well. We are completing the services there. There is a very, very good take. And the reason why I feel that we can compete in that space with the digital banks is the recognition of the brand, number one, the strength of the balance sheet of JP Morgan Chase that give the confidence to customers to leave more money with us than they will do probably with a digital banks. And since we are starting from zero, we have created a brand new modern platform that gives us the ability to develop an amazing customer experience. So on top of that, we bought Nutmeg, which is a digital wealth management that we are going to incorporate in our platform. And also the third biggest retail banker in the world is Brazil. So we bought 40% of a digital bank called C6. We have a path to buy more if we decide to do so. When we started talking to them, they have 5 million customers, a year or year and a half after, they got to 17 million customers. And a full platform, all the services, wealth management, small business, lending, and savings. So I think that we will see how the journey goes. So far, we think that is doing better than we were expecting. There is a role for other types of digital banks. We are challenged for them and for us as a pure digital bank is to get to the point of profitability. We are very new, we haven't got it, and many of those haven't got it to that point either. But so far, I think that the ability to, a company like JP Morgan Chase, to really be committed to it and continuously invest in the long term is very, very important and give us a competitive advantage.
Thank you. Noah?
Well, I think it's, as an established institution, you have to embrace the fintech sector. Competition's healthy in all markets. Every institution will take a different view on where to compete and who to compete with. But you've got to embrace fintech. So in that regard, we've invested about $700 million of our own money into a range of fintech-related businesses. And we're doing it primarily to actually learn and collaborate with them rather than just see it as a financial investment.
Sort of helping you to enable,
and bring that technology into the bank, right. So to continue our digitization journey of HSBC and to learn and collaborate with them, make their business stronger, but bring capability into the bank as well. In terms of one particular journey we're on here in Hong Kong, we set up, one could argue, a cannibalization of some of our payments architecture here in Hong Kong with the PayMe infrastructure we built, which is providing a digital wallet solution between consumers and businesses. And we've now got 2.9 million people on that network, and we're growing the merchant base rapidly. And that, for us, was an important milestone for us to actually go in on a very different sort of banking solution. Clearly, we're a relationship bank at the heart. We provide services to both consumers, SMEs, and large, to corporates as well. But we embrace innovation and technology, and we thought it was important to build a digital wallet here in Hong Kong. And we're getting close to 50% market share of the consumer base here in Hong Kong after about 3 years of building that. So that's good. The next stage for us then is how do you innovate that model elsewhere? How do you take that model to other places? So my message on fintech is competition's healthy. It's everywhere, every market you operate in, and embrace it.
Thank you. So back to Rob. So, you mentioned actually just now about Aladdin, which is a wonderful analytical tools. And this is pretty amazing because, you are one of the largest asset managers in the world, but you incubate this internally and develop as a great, new business line. And it's actually offered to your customers, yourself, as well as to your competitors. So tell me a little bit of how this gets, developed internally as an important technology tools.
Well, I think these days everybody wants to be a technology company. So if you read any bank's or asset manager's earnings report, it's going to say that they're investing in technology. We're reinventing ourselves through digital capabilities. So we're very supportive of that mindset. We've been doing this for the last 30 years. Believe it or not, when we started the firm, I would never think I would have an artificial intelligence lab. We have citizen developers on investment teams using APIs and advanced data science capabilities to build a portfolio. And we also have $1.3 billion a year coming in through our fintech business, which grew north of 10% again last year. So the one thing I know about technology in every asset manager or financial services firm, there's one thing in common. They have an endless list of things to do. So increasingly, what is happening is the world's largest investors really want to focus their time, energy, and resources on true points of differentiation, which is what my colleagues here talked about, how they're going to navigate the markets, how they're going to generate performance, and how they're going to manage client relationships. But for everything in between, especially having a scaled investment technology, they really just want access to the best. And they don't want to recreate the wheel. And that's where Aladdin has come in. So since the very beginning, Aladdin is our proprietary risk management platform. It's been one of our foundations that separates us. And the portfolio managers of BlackRock are Aladdin's biggest users. So we view this user-provider model as one of the principles of Aladdin, and something that does differentiate us from others, as you mentioned. But at the end of the day, both asset management and technology solutions are businesses that are based in trust, as was said in the previous panel. And our clients have put their trust in us to put their best interests first, and what we are applying is the fiduciary mindset of which side of the business they're on. So the way I would describe it to you is Aladdin is a tech platform that unifies the investment management process. So beyond enabling better risk analytics, it's created a highly efficient and integrated model and an integrated solution that allowed us to scale and grow, and unified employees because we work from one database. There's only one number that they can use across the firm. There's only one language that they could use across the firm. And we have a shared process and a common system. So we took this decision many years ago. It was a big argument of what we should do. And we took this decision to make it available to clients as a service provider. And it's continued to develop over time in response to their needs. Now, I have to say, and I always write it down, to be clear, Aladdin does not make investment decisions. It does not perform roles of an investment professional, nor does it make decisions for any professional in the process. It just enables investment professionals to conduct their work more easily by enabling quick access to the information that they need to make and execute on their own decisions based on their firm's objectives and decision-making frameworks. So lastly, and to be very direct, each Aladdin client has their own customized version of Aladdin. That's how we do it. So their version of Aladdin is hosted in a dedicated environment, segregated, and protected from other Aladdin clients, including BlackRock. So technology now has enabled us to provide more choice to our clients. We're able to provide clients with differentiated analytics on their whole portfolio. So as we grow, the clients' demands are changing. They're looking for new products, strategies, solutions. Aladdin is going to continue to grow and provide more value because the markets are growing, the products are growing, the ecosystem is behind, and we have to catch up. And Aladdin is enabling many people in this room, and certainly BlackRock, to help keep track of that.
Thanks, Rob. Crystal clear on neutrality of the narratives. So. You did touch upon this point of AI and big data. So I'm going to go to Noah because you have a lot of data. We know in the technology world, having data is great, but also having data can creating a lot of inherent tensions. You know, the startup versus the traditional financial service company look at data very differently. I think, you know, the client privacy oftentimes conflict with their demand for tailored product. And then also there's a compliance issue, which also could conflict with the demand for pulling data from multiple channels and resources. I know you have been collaborating with Google, the very leading big data company, the AI company, you know, in the digital space. And how is that partnership come along? And what is HSBC try to get from this partnership?
Yeah, thanks, Neil. And let me just clarify. I mean, if you look at if you look at a bank like ourselves or JP Morgan or Standard Chartered, we have a huge amount of payments data, huge amount of trade data, huge amount of foreign exchange data, and client data. Now, one of the biggest challenges for an international company is when you're moving significant amounts of money and goods around the world is making sure you're detecting fraud and inappropriate financial crime. And that's where the power of AI comes into play, because what you're trying to do is to take that fraud detection, financial crime detection methodology onto the next level. Instead of using simple algorithms or even complex algorithms, you're trying to take it to the next level. And what we're doing is partnering with Google to try and build the next generation of essentially sophisticated analytics using AI techniques to detect patterns of behavior that could could suggest there is fraudulent or financial crime activity taking place. And that's particularly important because the level of sophistication of determined actors in that space is increasing by the week and by the month, because they're using the same techniques, they're using the same capabilities. Now, in building those models, in building that AI, you're not contravening any data privacy issues, because you retain the encryption key, you retain the capability, you're using the tools, but it's not being used in letting customer data go outside of a data privacy wall. But you're using the analytics capability to try and really get sophisticated modeling and detection capabilities for fraud and for financial crime. And that's what we're doing. But I'll be surprised if our competitors in the room today aren't doing a similar thing. And I know from a regulatory point of view, all regulators around the world are keen for the financial system to keep upgrading its capability to make sure it has the ability to detect inappropriate behavior. So that's the primary use. Using AI for other reasons, you may have different considerations on privacy and use of data, but when you're fighting financial crime and fraud, I think you've got to keep going to the next level of sophistication.
Thank you. So same question to Daniel and to Bill. So how is AI and big data being used in your customer services and offerings?
So it's been a long journey too. So one of the, obviously like everyone else, we set up our research labs of artificial intelligence, and we have a center of excellence and all that. But for this technology really to be powerful, like anything else, you need people to use it. And then you need to really teach the organization the power of this technology to have more and more and more use cases. And as time goes by, there are more and more use cases coming along. I will mention a few. Markets, the fixed income trading and equities trading. More and more, we are moving from rule-based algorithms that are very simple and execute whatever you give the constraints to smart algorithms that they are quoting transactions to clients and doing the risk management and executing in the market. So we do it for several asset classes at the moment. So fraud, Noel mentioned about fraud. When you have, no matter how sophisticated a normal algorithm is, you're going to have a huge amount of false positives. What AI comes into is to really reduce those number of false positives and create the number of cases that people have to investigate to be a lot smaller than it would have been otherwise. And in the retail business, is really fascinating, all the things that we are doing. I'll give you an example. So call centers. We have call centers around the world. Today, when a customer calls, so he talks, that person talks to one of the people in the call center. As the conversation goes, the machine is listening to that conversation and providing feedback to our employee of what would be the possible solutions to the problem that customer is calling for, reducing the amount of time to solve that problem substantially. And we are using it in many other cases, offers. So in the retail business, instead of being bombarded with things that you will never do or will never consume, is more help us to target it. So there are many, many applications that is evolving every day. But the good thing that I feel, at least in our company, is now just become more mainstream. So everyone in the company knows the power of this technology. And when they think about customer solutions, the AI machine learning component of it comes quite natural, and it wasn't the case a few years ago.
Okay, Bill?
If I could just try to build on the excellent comments from Noel and Daniel. Each of them talked about the way that we're getting more sophisticated using data that's in-house. To me, one of the really interesting frontiers is how we incorporate data that's coming from the network, from outside. And maybe to pick on one of Noel's examples around financial crime. In fact, the three of our firms have worked together in various efforts to use the data that we have across our 3+++ firms to identify patterns of cross-bank behavior that indicate financial crime. We brought down some really serious human trafficking rings, for example, through the use of a coordinated attempt at taking all these tools that Noel and Daniel have talked about and applying them not just to our own data sets, but to the data sets that exist in terms of payment flows between banks, or eventually between banks and our customers. The second network effect that's critical for us is maybe getting back to, Neil, some of the questions you asked about the way partnerships work. There's always an exchange of data in a partnership, and the data is orthogonal. I mean, the data that we get from Hong Kong Tel or from Bukalapak in Indonesia, our partner there, largest e-commerce platform, it's very different data than the data that we get ourselves. The data that we have is very different data than they have. And the combination of that data, of course, respecting all the inherent privacy requirements and restrictions, is exponentially more valuable than the data that one side or the other has. So I think that the next frontier is how we create, in an appropriately guardrailed and ring-fenced sort of way, how we create these data networks that are fundamentally more valuable than the data that we ourselves have. Added benefit of that is that a bank that isn't as big as HSBC or JP Morgan can actually compete directly, because we have natural data partners that will want to deal with a bank that's a little bit smaller rather than a bank that's a little bit bigger. And I'm not saying, like, my objective isn't to compete with Noel and Daniel sometimes. But obviously, we do much more together, frankly, than we do competing with each other. But the use of data, the use of data networks, is a fundamental leveler of the playing field, which I think is good for competition and therefore good for consumers, good for societies.
I think Bill's trying to get me to open a Mux account.
You're most welcome.
Okay. Well, thank you. One last question before I open the floor. I just think we have 4 or 5 minutes to go. This is a quick one. So globally, the regulators are all looking at crypto and blockchain. And clearly, the regulators are stepping up their efforts to put this into their regulatory scope, right? So as leading financial service company, what the advice you give to the regulators, or what do you expect that they could do to, one, make sure this market continue to grow healthily? Second, there will be great protection for customers. Anyone?
Yeah, my only advice to regulators is to the cryptocurrencies, and you're talking about non-fiat currencies here as opposed to the digital, the stable coins and things like that. Bring it into the system. Don't leave it out. Bring it into the system. You can watch it, observe it, understand where it's getting, where speculative bubbles are building. Leaving it outside, it's going to be very hard to control. It's not going to go away because regulators wish it away. So I think the proactive approach that the HKMA is taking is exactly the right one. I know you're going to be cautious about how you do that, and you should be. But the opportunity to bring this into the system, I think, is correct.
I think if you look at the technology that crypto is based on, the technology is not the thing to regulate. Technology should be free to innovate. When that technology produces a product that becomes an asset class, which pure crypto has become an asset class, there's a strong argument to say, and particularly when that asset class is being bought by the mass market, then there's an argument it should come into the regulatory environment. If it's a technology facilitating payments, that's different. If it's a technology that becomes an asset class, and that one asset class is unregulated, but all other asset classes are regulated, it feels strange to me.
Thank you.
So clearly, it's a very highly speculated small asset class as it stands at the moment. And I agree with Bill and Noel. So if you look at how regulation is trending today, is towards particularly the crypto assets, the non-fiat crypto assets, they are going to be left outside the banking sector because the capital rules that they're putting in place are quite punitive for any regulated entity like a bank to participate. So probably regulators should reconsider that and say that it's safer for the consumers to operate with regulated entities as they do all the other financial services need. But at the moment, the trend is not coming this way.
So instead of investing in it directly, you should have it professionally managed. Is that what you want me to say? I think it has to mature more, and we're not there
Before,
yet.
okay.
Yes.
Good. So I think we're running out of time. Just one question for the floor, if any. All right. Looks like we're all set here. So let's give round of applause to this wonderful panelists for sharing the insights on tech. Thank you. Thank you.
And thank you, of course, Neil Shen. Great job on moderation today. Gentlemen, if you could move to the center of the stage for a photo. We're not going to let you get away that easily. There we go. Don't want to miss out on a gathering of those handsome mugs. All right, thank you very much. I would like to share with you a little something personal, something kind of strange that happened to me recently. I've lived in Hong Kong for 26 years now. I got here 1996, and when you live in Hong Kong for a long time, you notice something that I think is almost unique to this city. There are these birds of prey, raptors. They're called black kites that hover over the city. You can almost always see one somewhere up there riding the thermals, but they're always far away. It's almost like they never land. You never see one up close. You wonder if they just disappear at night and come back in the morning up high in the sky. So about a week ago, we were having a meeting at the 55th floor of IFC2 at the other end of this complex, a meeting at the Hong Kong Monetary Authority offices planning this meeting. And while we were having the meeting, as we were wrapping up, one of these birds, almost mythical birds, the black kite, came and lit outside of our meeting. And he didn't stop and fly away again. He immediately stopped and stayed. Didn't appear to be doing anything, just supervising our proceedings, keeping an eye on us. And it was really special, not just for me, but also for the people who work at the heights of IFC2 at the HKMA. They said they had never seen anything like this before. It was quite rare and special. And we took it as an omen that this was a sign that Hong Kong is taking off again. So we were quite excited by this. He stayed around so we could all take photos. This black kite was very gracious and bestowed his blessings on us that we were happy to have. Someone who I also know thinks that Hong Kong is taking off yet again is someone who moved heaven and earth to be here with us today. Heaven and earth and maybe a lot of sand that he kicked out of his shoes On the way in here, we now welcome the Financial Secretary of the Hong Kong Special Administrative Region of the People's Republic of China. Please welcome Mr. Paul Chan.
Distinguished speakers and guests, ladies and gentlemen, good afternoon. It has been a brimful and hope rewarding day for all of you so far. The rewards will continue with a fine lunch from Eddie in just a few minutes. In the meantime, I'm here to sharpen your appetite for Hong Kong business and investment. Looking to the future, the potential and opportunities of Hong Kong as an IFC is just boundless, thanks to the unique connectivity with the mainland and the world. We are determined to excel in many areas. Among them, our fundraising platforms, our role in renminbi internationalization, the unique connect schemes with the mainland, asset and wealth management, Center for Risk and Corporate Treasury Management, and much more. The list could be long. But to echo this morning's inspiring panel discussions, please allow me to highlight Hong Kong's development in just two areas: green and sustainable finance and fintech. Around the globe, governments have been drawing up action plans to peak gashouse emission and achieve carbon neutrality, seeking to reach the targets in the Paris Agreement. The mainland has set out its 30-60 zero carbon targets, that is, peaking carbon emissions by 2030 and achieving carbon neutrality by 2060. And in Hong Kong, we set our target to reach carbon neutrality by 2050. Along the global momentum, Hong Kong has this vision: to become a premier center for green and sustainable finance that serves the green transformation in the mainland, the region, and the world. On this, we have much confidence. The National 14th Five-Year Plan supports Hong Kong's development into a green finance center. In particular, Hong Kong's strategic position in the Guangdong, Hong Kong, Macau Greater Bay Area, where green transition is high on demand for this burgeoning 11-city region with a population of 86 million. Adherence to high international standards is also why we have good prospect to succeed. We have reporting and disclosure standards that align with international best practices. We are seeking to adopt a green classification framework along the common ground taxonomy. Green bonds issued in Hong Kong are trusted by global investors. In realizing this vision, we lead by example. We issue government green bonds since 2018. Through the concerted efforts of regulators and the industry, green and sustainable debts issued or arranged in Hong Kong reached more than $56 billion in 2021, 4 times that of the previous year, and topped in Asia. Deep liquidity aside, the market covered a diversified investor base and project categories. We continue to provide expensive subsidy for eligible issuers and borrowers for their borrowings in Hong Kong. In many ways, we are setting benchmarks and standards for green finance in this region. Last year, we became the first Asian government to issue 30-year and 20-year green bonds denominated in US dollar and euro, which were the longest tenure of Asia government bonds at the time. The response from investors were overwhelming. Mainland provincial and municipal governments are supporting our efforts as well. Shenzhen, our neighboring city, was the first mover, and they issued their first ever offshore renminbi green bonds worth 3.9 billion renminbi in Hong Kong last year. It was followed by the provincial government of Hainan, which announced just last week the issuance of blue and sustainable bonds worth 5 billion renminbi in Hong Kong for marine and sustainable projects. Green finance seeks to support humanity's responsibility for the environment. And we do not forget that this is what our people should own and benefit from. In May this year, we issued the inaugural retail green bonds to the order of 2.5 billion US dollar, which is also the largest globally. The costs are slightly more expensive and administration a little more burdensome, but it will reinforce our residents' sense of ownership of our green vision and help us achieve financial inclusion goals. Allow me now to turn to the future of finance. The key word to this is definitely fintech. Hong Kong's strength as an IFC and as part of GBA facilitate our development of a strong fintech sector. We have an extensive presence of top global financial institutions here, providing a complete range of financial services, a deep pool of financial expertise and talents, an internationally recognized regulatory regime, and sophisticated IT infrastructure, etc. Building on this foundation, we have been adopting a multi-pronged approach in fostering fintech development. They include, first, forward-looking and facilitating policies and measures. For example, a FinTech 2025 strategy has been promulgated by the Hong Kong MA to help all banks to go fintech. Sandboxes of all the financial regulators are linked up to facilitate development of cross-sectoral fintech solutions. Two, encourage innovation. For example, we issue on Monday a policy statement on virtual assets. We make our policy stance clear to the markets to demonstrate our determination to explore financial innovation together with the global VA community. Third, development of essential infrastructure. For example, a faster payment system connecting all bank accounts and electronic wallets for individuals, enabling them to make instant transfer between all these accounts and between individuals. The commercial data interchange allows businesses to share operational data on a consent basis so the banks may make better informed assessments of loan applications, while SMEs may have access to financial services more conveniently. Fourth, leveraging on our unique superconnector role to facilitate cross-boundary collaboration in the development and application of fintech solutions. cross-boundary supervisory sandbox in the GBA is a recent example. Besides, an online platform will be launched to connect Hong Kong fintech companies to users, partners, and investors in the mainland, Southeast Asia, and beyond. Meanwhile, the Hong Kong MA is also working with the Bank of International Settlements and 3 peer central banks on the M-Bridge project, exploring the use of CBDC to expedite cross-border trade settlements. Fifth, capacity building. We ensure there are facilitating and welcoming policies to attract mainland and overseas talents, while providing subsidized training and education opportunities for our own locals. Fintech qualifications have been established under the qualification framework so as to provide a clear career path to fintech practitioners. The recent policy address of the Chief Executive has also rolled out even bolder measures to attract talents. The sixth, nurturing the ecosystem. We provide subsidies for firms in their technology adoption, provide incentive for startups and private equity firms to establish here. And we have set up funds to support and invest in fintech companies at varying degree of development. Last year, we rolled out an electronic consumption voucher scheme. As a result, consumer accounts and merchant accounts of the relevant store value facility operators have increased by more than 8 million and 150,000 respectively from the year before. Application of electronic payment has now infiltrated into different businesses and walks of life, from shopping centers to wet markets, from hawkers to taxi drivers. We have come a long way in a short time. 5 years ago, Hong Kong counted no more than 180 fintech companies. Today, we are home to more than 800 companies. Many of them are founded by entrepreneurs from the mainland, France, the UK, and the other places. We have also nurtured several local unicorns. But we do not stop here. The virtual asset policy statement mentioned earlier sets out our vision, regulations, thoughts on investor protection, and attempts in emerging areas such as NFT tokenization and e-Hong Kong dollar. As an IFC, Hong Kong is open and inclusive towards global innovators. We are working with the financial regulators towards providing a facilitating environment for the sustainable and responsible development of the virtual asset sector in Hong Kong. Ladies and gentlemen, in short, our prospect of green and sustainable finance and of fintech are highly promising. But before I keep you further from your lunch, may I express thanks to the Hong Kong Monetary Authority for organizing this inspiring and thought-provoking summit. My thanks too for your participation, for your unwavering belief in Hong Kong. Thank you very much.
Thank you very much, Mr. Financial Secretary Paul Chan, for joining us today. Ladies and gentlemen, a lot of you last night, as I mentioned earlier, thank you. As I mentioned earlier, a lot of you were at the M+ dinner last night. It's a fantastic institution, new to Hong Kong. I've been, I love it. And we have a special video to bring you back to some of the memories from last night. Thank you. And that was you. And with that, ladies and gentlemen, we are going to be having lunch, appetizers, mains, all on the way, but we are going to be having a really spectacular fireside chat over dessert later on, so I will leave it with bon appétit. Merci.
Thank you.